Hello, everybody. Ed Denny here. I'm glad that you could join me today. It's a hot day here in Long Island. I think it's hot just about everywhere these days. But yeah, I mean, I even went on a business trip over the weekend. It was a conference I attended in Montreal, and it was just as hot there. So we'll see. Hopefully, this will break soon. And already time is flying. It's already August 8th, and people are starting to talk about the fall. September is coming, so I don't want to talk too much about it because I think most of us want to get a couple more weeks, 4 more weeks out of the summer. What can we talk about? Well, there's lots of things to talk about, obviously. Just as everyone agreed that we are in a technical recession with real GDP down in the first quarter and in the second quarter, guess what? The labor market didn't confirm that. Labor market hasn't confirmed that all year, but the real GDP numbers were negative, and 2 quarters in a row of negative GDP is commonly thought of as a so-called technical recession, but it's not an official one. And this technical recession may never get to be categorized as an official one by the dating committee of the National Bureau of Research. Indeed, it's conceivable that the negative numbers, which were just slightly negative in the first half of the year, will be revised upwards. Let's look at some charts along that line here. Get right down to it. And I think I have it over here. Good. Okay, so this is the chart collection for this morning. You folks got the morning briefing this morning. Some of you might have gotten an advanced copy yesterday. Anyways, here's GDP. GDP is the red line, and this is in current dollars. I'm going to do some work on it in real dollars, but it's not going to change the story. If you look at it in current dollars, we're at an all-time high in nominal GDP. And if you look at gross domestic income, which is another way to measure the activity in the economy, you can see that through the first quarter, there has been a widening divergence. So we're all waiting for a few more weeks. We'll get a revision for the second quarter, and that revision will include the first quarter of gross domestic income. Gross domestic income is calculated by adding up things like compensation of labor, corporate profits, rental income of landlords, and so on. So it's measuring the income side of the economy, whereas gross domestic product measures the demand side, so consumption and capital spending, inventories, residential investment. And generally speaking, they follow each other pretty closely, but this divergence is very odd. There's some folks who believe that the GDI is actually a more accurate measure of what happens. So we'll see. If that's the case, there could very well be an upward revision in both the first and second quarters when all is said and done. National income is just one of the 2 components of gross domestic national income. National income is what we add up, as I said, by just looking at the income side of the equation. And then to that, as you can see by the footnote here, that GDI is equal to national income plus depreciation. Another slice and dice of the same story. You can see that it's very unusual to see this kind of divergence. When you take GDP less GDI, it's turned very negative here. And that's not just a function of a larger and larger economy. As we divide this by GDP, even scaled for that, you can see that we've got a remarkable divergence between these 2 measures. So again, it certainly was lots of controversy about whether we were falling into a recession or not in the first half of the year. I think that it's pretty clear that at most it was a technical recession, and it may not even be. I mean, on revisions, it may not even be that. The index of coincident economic indicators tends to be the indicator that the dating committee actually uses to decide whether an economy has peaked and when it's troughed. And as you can see from this chart, the peaks and troughs coincide almost always. I guess I'm not quite sure what happened back here, but almost always they coincide with the, I'm glad I used the word almost. You can see that they coincide with the peaks, troughs, peaks, troughs, and so on. Now, the index of coincident economic indicators includes 4 indicators: payroll employment, real personal income excluding transfer payments, and manufacturing and trade sales, and industrial production. So what do we know so far? Well, we know that July payroll employment was up at a record high. And if payroll employment is that strong, that's bound to have an impact on real personal income. As a matter of fact, Debbie and I calculate something called the earned income proxy based on total hours worked, which reflects the work week, the length of the work week, and the number of payroll employment. And then we multiply that by average hourly earnings as a wage measure. And that is very highly correlated with wages and salaries in personal income. And guess what? It also is a record high. It was up 0.8% in current dollars month to month in July. That's the good news. The bad news is this is inflation adjusted, and inflation's taking a lot of the strength out of real consumption and real spending. The good news possibly is that the July CPI and deflators are expected to be very low on a month-over-month increase, maybe like 0.2% because of the drop in energy prices. And so it may very well be that July will finally see consumers actually getting some decent increase in their real purchasing power, and we'll see that in consumption. But the index of coincident economic indicators certainly doesn't look like it's going to be peaking. Oh, I know why I got that wrong back here. This is not the overall index. This is this is just the payroll. The overall index. Let's go to the videotape. I think that works better. You can see peak, trough, peak, trough, peak, trough, so on. Okay, so the coincident indicators, I think, are really the monthly indicator that the dating committee really bases what they're thinking was actually a recession. And it takes them a while to come up to that conclusion. However, we're not out of the woods yet. Still the recession worry just when we are less worried about it. I guess it'll make a comeback here at some point. The index of leading economic indicators, and you can see that tends to lead by 9 months, 10 months, 16. On average, it leads by 12 months. And so it peaked in February, and I guess we can worry about the LEI predicting a recession early next year. That's not our forecast at this point, but the LEI is increasingly getting bearish on the economy down the road. In figure 5 here, what we're looking at is what I just said about the consumer. This is the earned income proxy, YRI's earned income proxy. And you can see that it's aggregate weekly hours times average hourly earnings of total private industries. So it's just for the private wages and salaries. And you can see that in current dollars, it's a pretty good indicator of nominal wages and salaries in the private sector. And that's because that's exactly what the government statisticians use. They use exactly this kind of methodology to estimate the wages and salaries components of personal income. So we have this through July, all-time record high. However, when we adjusted for inflation, and what we have for inflation so far is through June, for the deflator, we won't get the deflator for another month or so. The CPI we're going to get on Wednesday, so everybody's going to get excited about that. But you can see that the earned income proxy is kind of flattish of late. But July could be an uptick, as I said, as this 0.8% increase might translate into maybe even a 0.6% increase in real purchasing power. Meanwhile, as everyone who thought we're heading into recession had to concede, there's no recession in the labor market, and there's still no recession in the labor market. And people have been writing articles about how we could have an odd recession with employment remaining strong and yet the economy being in a recession. That's just doesn't make it, in my opinion, doesn't cut it. But again, that's what's so much fun about this business is you can look at this series on payroll employment, so everything's just great. And then if you want to still worry, you can look at household employment and see that that's been going flat. Household employment measures the number of people who have jobs, whether they have one job or two jobs or three jobs, doesn't matter. So this is the actual number of of people with jobs, whereas this is the account of the number of jobs. So you may be wondering, so why is household much higher than payroll? It includes self-employment. It's got some other funky things going on there that have differentiated it from payroll employment. But again, this is the number of jobs, and this is the number of people with jobs. And this is the labor force. The labor force, this hasn't been growing either. If this thing starts to stall, and this continues to stall, I guess we'll be worrying about a recession. I think we're kind of in a growth recession, which means the economy isn't growing much, if at all. It was down slightly in the first half of the year. It may be up slightly in the second half of the year, maybe something like 1%. And I think it won't be until next year before we start to see better growth of 2.5%, maybe 3%. But again, that's not the LEI, the leading economic indicators, obviously is got a different opinion at this point. We'll watch it. But meanwhile, the diffusion of payroll employment by industries looks really good. 68.6% of industries had payroll increases. On a 1 month basis, 3 month it's 74.4. So there's still plenty of hiring going on. As I just mentioned before, average hourly earnings for all, not for all workers, but for production and non-supervisory workers, that is actually up 6.2%. The deflator is up 6.8%. So again, you can see that inflation has reduced the purchasing power of wages. And you can see that even more clearly here when we take average hourly earnings and divide it by the consumption deflator. I think one thing that this chart blows away is this notion that real wages, real standard of living. I mean, what is the standard of living but the purchasing power of wages and the number of people working? But at the end of the day, it's real wages, and the real wages have actually been on an upward trend here, rising around 1.2% per year at an annual rate. That compounds to something like a 20-25% increase in the standard of living. So that totally is at odds with the notion that progressive and other lefties have been saying that American workers have seen no improvement in their standard of living for decades. That's just not so. And you can see that right now it's so that there's been a stagnation in the wages. So everybody's been getting, not everybody, mostly lower wage workers have actually been getting the big wage increases, not higher wage workers. They're actually, I think the lower wage is like 6.5%, and the higher wage workers about 2.5%. So inflation on balance has reduced the purchasing power of everybody. More the higher wage workers than lower wage workers, but people have been getting wage increases, going to the stores and realizing that it doesn't buy you any more. In some cases, it buys you less. So when the employment numbers came out on Friday, we saw that the 2-year yield shot up to 3.24%. So one of the consequences of Friday's number is the market went from thinking, well, maybe 50 basis points in September is what the Fed's going to do. Now I think we're back to 75 basis points. And it really shouldn't have been a matter just of the payroll numbers or the 2-year. The reality is 5 Fed officials gave speeches or comments last week in which they said that they're a long way, they think they're a long way off from having done what they need to do to bring down inflation. And that basically what they did is they walked back Powell's comment in his press conference at the end of last month, saying that he thought we're at neutral right now at 2.25% to 2.5% on the Fed funds rate. And the market immediately interpreted that as, hey, the Fed's therefore close to being done. They'll go restrictive one more time and that'll be the end of it. And now that's not the case, as 5 Fed officials did some damage control, and certainly the week last week was capped off with that employment report strongly indicating that the Fed's going to do 75 basis points, or should do 75 basis points rather than 50 basis points. Let me wet my whistle here. Okay, so it's of course, the yield curve inverted some more, and it's inverting again today. I think we're like at 3.2% on the 10-year and the 2-year, and something like 2.8% on the 10-year. So we are seeing this inversion. And again, we're not out of the recession risk woods at all. Certainly with this thing still down. I think the yield curve has a tendency to anticipate financial crises, credit crunches that cause recessions. And maybe that's what the yield curve is saying is the Fed goes another rate hike, 75 basis points. It's going to be something could break. So we'll have to be aware of that, because it's actually been a pretty decent predictor of something breaking in the financial system, but maybe it won't break here. The banks are very well capitalized. Consumer balance sheets are in pretty good shapes. Clearly, there's some issues with auto loans and things like that, but I don't think there's anything like the kind of credit issue that typically brought the system down into a recession. Not here, anyways. Europe's may have a recession related to its energy crisis, and maybe something will break over there. But the other possibility here is that the bond market sort of agrees with something I've been pointing out of late, and that is all these Fed critics who've beat up on Jerome Powell for saying that we're at neutral already. What if he's right? What if 2.25%, 2.5% is in fact already neutral? I mean, it sounds kind of too low relative to where inflation is, where the labor market is, and Larry Summers has certainly come down hard, saying that the Fed is delusional if they think this is neutral. Not the Fed, but Powell, because he was the one being quoted. Fed officials have scrambled to walk that back. But as I've said before, a strong dollar, I think, is at least 50 basis points. Quantitative tightening, which is just really starting, that's at least 50 basis points. So there you got a 100 basis point increase in the Fed funds rate above the 2.25%, 2.5%. So we're already at 3.25%, 3.5% for all practical purposes in the Fed funds rate. And it's not just that. The mortgage market also we saw tightened from 3% to 6%, maybe down from that level somewhat. But the mortgage market figured out that if the Fed's not going to be buying mortgage-backed securities, then it's time to hasta la vista. Let's get out of here. And that's what they did. And once they got to 6%, buyers came in the mortgage market. But meanwhile, buyers in the housing market clearly have been turned off by the affordability issues as mortgage rates have gone up. One last story in the morning briefing, which is kind of interesting, I think, is that if you look at the 12-month change in non-farm payrolls, you can see that over the past year, we've, on balance, net hired 6.1 million workers. And if you show, well, what percentage of that is payroll employment? It's only 4% of total payroll employment. Still an impressive number, but it's only 4%. But that really understates the kind of turnover we have in the labor market, which is really fascinating, just how much turnover there really is. I almost didn't publish it because I found it a little bit hard to believe, but I published it, and you let me know if you can figure out what's wrong with this analysis. Total separations, which is layoffs and quits, 72.2 million people over the past 12 months through June. Total hires, 78.3 million workers. To put that in perspective, let's divide that by payroll employment today. And you can see that total separations have been almost 50% of payroll employment. Total hires have been over 50% of total payroll employment. So these things have always been in the millions when you take the kind of the 12-month sum as a percent of the actual level. And when you do that, you find that we're not at a record high on hires, but we're right up there, and we're not at a record high on separations, but we're right up there. But maybe all this churning explains why the number of jobs that are outstanding are so high. So you can look at the rest of this on your own. Well, this also explains why we have so much job switching going on. According to the Atlanta Fed's median wage growth tracker, Job switchers over the past year have gotten a 7.9% wage increase, whereas stayers got 6.1% increase. Adjusting for inflation, that means that the job switchers have gotten all of 1.1% for all their effort, whereas job stayers have gotten a 0.7% decline. So, people, I think, still have sort of money illusion. They're attracted to a big offer, and certainly a good idea to switch if you can get more money than where you're staying. But it's been kind of a depressing experience for most workers to realize that their purchasing power really hasn't increased as much if it hasn't actually decreased. And that certainly explains why consumer sentiment is so depressed. Well, don't want to depress you anymore. Let's see if we can talk some happy stuff. I did want to, let's see, I don't know if I have it here. No, I thought I had it. Oh yeah, I did want to point out that, we now have these quick takes whenever I'm inspired, see something I really want to get out to you quickly. We put out these one-page quick takes, and the latest one I sent last night showed this chart, which shows the forward PE versus the 10-year U.S. Treasury yield inverted. So here's the Treasury yield inverted, got to 3.5%. Now we're around 2.8%. Let's keep an eye on this relationship between the forward PE, which jumped from 15.3 to 17.4. I'm thinking 15.5 to 17.5 is kind of the reasonable forward PE. I mean, going back to 20 would be insane. I can't rule it out. I know one of my competitors is saying we're going to make a new record high in the market by the end of the year. To do that, you have to be extremely bullish on forward earnings, which is hard to do when analysts are actually cutting their numbers, or have to conclude that despite analysts cutting their earnings estimates, the market's going to go to 20 PE where it was at the beginning of the year. That's a little bit hard for me to imagine. So I'm imagining 15.5 to 17.5, and we're basically there now on the top end. So let's see what the bond yield does. Obviously, if we get a whole bunch of numbers suggesting that we've got a growth recession going on and the bond market can live with that, and we get a really good CPI number on Wednesday, there could be more upside than range bound trading. But then again, the market looks ahead, and the market may have anticipated that Wednesday's CPI is going to be quite moderate. The expectations is 0.2% for the headline, and I think 0.4 for the core. And the market may look beyond that and say, okay, what's next? I mean, the reality is I'm looking for a peak in inflation like everybody else is, and I suspect the July CPI on Wednesday will give us more evidence of that. But we're not seeing it yet in the wage numbers. The wage numbers are still showing that there's a wage price spiral going on, wage price rent spiral, actually. So let's open it up for a little discussion. Let me do this again. Okay, so Scott, what if inflation stays in the 4 to 6% range for a number of years? The benefits of globalization, cheap commodities, low interest rates, higher wages, and low energy prices appear to be behind us. There's been very little investment in these areas for almost a decade. Your thoughts? Yeah, I mean, I don't think we're going to go back to 2 to 3% inflation anytime soon, or ever. We'll figure that out along the way. Always want to leave yourself some options here. I know there's actually, I think Kathy Wood has been talking about that the next thing that'll happen after this is deflation. But you're absolutely right. I mean, we've been looking at 4 deflationary forces that have kept inflation down since the early 1980s. Globalization is one of them, and or détente. Obviously, we don't have much détente going on these days. We still have a lot of trade going on. Even the world still has relatively free trade, with the exception of what's going on with Russia and Ukraine. But for all practical purposes, globalization still hasn't taken a big hit from what looks like a geopolitical deglobalization, for sure. Technology, on the other hand, remains fundamentally deflationary force. And I still think that labor shortages are forcing companies to figure out how to increase productivity. I know that the first half of the year, went exactly the wrong way for that kind of story, for my story. But I think it'll make a comeback here. So technology, I think, is inherently deflationary. Demographics, I think, is inherently deflationary. I don't think that changes much, though. Again, everything has there's two sides to every story in economics, and the other side of the story is if you got global labor shortages, why wouldn't the wages go up a lot more? And I think the answer is because I think companies, I think they will in real terms, and I think that'll have to be justified by productivity. Another deflationary force has been debt. There's too much of it. It's hard to stimulate consumption when people have already consumed so much. And we're seeing that right now in the demand for goods. So there's still some deflationary forces out there. But for the here and now and the reality of what we're going through right now, we're seeing some improvement in supply chains. We're seeing some moderation in demand, which is going to be deflationary for durable goods. It's the services side, particularly rent inflation, that's going to be troublesome for a while. On balance, I still think that inflation peaked in June. I'm looking forward to the July numbers to find some more evidence of it. Not yet seeing solid evidence of peaking wages, and certainly no peaking in rent inflation. But we'll keep watching it. So we're looking for, on a deflator basis, inflation, which looks like it ranged between 6 and 7% in the first half of the year. We're looking for it to range between 4 and 5% in the second half of the year, and then 3 to 4% next year. But we don't see 2 to 3% anytime soon. Thanks, Scott. Willem, the Inflation Reduction Act, what a joke that is. The Inflation Reduction Act appears from an aggregate demand perspective to provide a net stimulus. Does that mean it should have been called the Inflation Boost Act, and that is cyclically inappropriate? Willem, if you haven't copyrighted that, I might just take that. TNEC was not my invention. A fellow on LinkedIn was the first one, and I've given him credit for TNEC. You know, there is no alternative country, but yeah, I mean, I haven't studied it rigorously yet. Just read the accounts so far. I figured there's no point in getting into legislation before it's actually passed, because as we all know, it's kind of like watching sausages being made. But yeah, it seems on balance as though it's a lot of pork with some taxes, and the taxes are probably going to get passed on to the consumer. So it certainly it doesn't do anything helpful in terms of bringing inflation down. And to the extent that it's all a bunch of pork, it's not clear that any of that is going to meaningfully do anything positive for the economy. The good news is the economy is so huge, and there's still lots of capitalism in our economy that, you know, some of this corruption that goes on can be dealt with or absorbed by the amazing strength of the economy. But I, from what I've seen so far, but I can't say that there's anything particularly encouraging about it from a macroeconomic standpoint. And from a microeconomic standpoint, it's not going to solve the energy crisis. China just basically insisted that they need to have a free pass on climate for a while, because they're still a developing country and they're still trying to improve the standard of living of their people. India's basically said the same thing. So I don't get it. I don't get what's the point of Europe and the United States, you know, shooting ourselves in the feet when the Chinese and Indians are not going to do anything meaningful to reduce carbon emission. Okay, BC, hello Ed. Even if inflation settles at slightly higher levels, say it sustains at 3% or above, how would the 10-year bond yield stay at below 2% going forward, which the market is pricing? That's a great question. I mean, you know, if you look at real interest rates, they are still negative in a substantial way. We've got 2.5% to 3% bond yield, where right now what we know is inflation, depending on what you're looking at, is basically 6 to 9%. Let's call it 6%. Whatever it is, it's still ridiculously high relative to the bond market. The bond market seems to be, I think, influenced by TNEC. I think there's been a tremendous amount of global investors who concluded that the safe haven for investing is in the United States. And I've shown data from the TICS data that the Treasury provides that foreigners have in fact bought over the past 12 months through, I think it's June, it's something like $780 billion in our fixed income markets. But second half of the year could be kind of interesting, right? We really need them to keep doing that, which then would make the dollar, could keep the dollar strong. But in the second half of the year, right, starting basically in September, starting within a month, the Fed is going to accelerate its pace of quantitative tightening. And as I said, I think that's already equivalent to at least 50, if not 100 basis points. As I said, we're not out of the recession woods, and there's still going to be some issues here that are going to be difficult for the bond market. But then again, some of my indicators that I use that have worked pretty well, like the copper gold ratio, says the bond yield should be down to 2%. The Citigroup Economic Surprise Index has good correlation with a 13-week change in the government bond yield, and that's been bullish. So it's after Friday's number, it was a little less so. So I'm not quite sure what reality or delusion the bond market's operating under, but we have been arguing that bonds around 3% makes sense for now. And again, a lot of that's because of foreign buying and our perception that inflation is coming down. But you're right. I mean, Fed officials just keep talking about how their goal is to get it back down to 2%. I think they might want to stop saying that and just say they want to get it down meaningfully. That's what I would do. Doug, what is your expectation for the long-term outlook for productivity and unit labor costs? Well, you're setting me up for the kill here, because tomorrow we're getting second quarter productivity and unit labor costs, and I'm expecting it to be down. It was down horrendously in the first quarter. It could be down less horrendously, but pretty badly in the second quarter. Now, maybe this is all just fantasy. I mean, if we turned out to significantly revise upwards real GDP, which is what I was discussing at the top of this conversation, then what? Then maybe the productivity is down a little less than the first half numbers are going to show, and unit labor costs might be up a little less. But right now, the only explanation I can come up with various explanations for why productivity has been so disappointing, and maybe that corporations are so busy just figuring out how to raise their prices to pass on their costs that they haven't bothered too much with productivity. Also, maybe there's been a lot of labor hoarding with all the stories about how hard it is to get labor. So maybe they've been hoarding labor, then they hire workers, and then they find there really isn't quite as much for them to do as that they expected. I mean, certainly in the goods producing area, one would think that, and yet manufacturing employment was up 30,000 last month. So there's a lot of moving parts here, and some of them you kind of wonder whether they're got some defects. But I would say, you're saying longer term, I'm thinking we're going to see productivity, which bottomed on a 20-quarter annualized basis at 0.5% in 2015, end of 2015. It got up to 2% at the end of last year at an annual rate. Then it's back down to like 1.5% because of the weakness in the first half of the year. I think it's going to go up to 3.5% to 4.5%. And I think the labor shortages are forcing companies to increase productivity. I'll take one more from Steve. If Europe heads into a deep recession, what impact do you expect to the US market? Funny you ask that. I'm writing about that now for tomorrow. And exports to Europe matter. China is also a major exporter to Europe. So I think the global economic indicators are certainly showing a slowdown. And if you extrapolate them, they show that we're heading towards a recession. But we've seen slowdowns before where they didn't turn into recessions. But a slowdown is for sure on a global basis. And I think Europe and China are going to lead the way. I say that just as we just saw remarkable export numbers coming out of China, still a very strong exporter. What I don't know is how much of that is because of the prices have gone up as opposed to actual unit activity. But again, the indicators on balance show a slowing global economy. The U.S. has slowed along with the global economy, and if it's slow enough here in Europe and China both have serious recessions, that could obviously mean that the leading indicators turn out to be right, and a recession occurs next year, a bona fide official recession. I got to take this one from Gregory. How does the change in money supply impact your views on inflation and its trajectory? That's kind of become the big rallying cry of perma bears, pessimists, and the like. Look at M2 and how it's falling. Yeah, but look at how it soared prior to the past couple of months. So I don't get too phased here by looking at the year over year or month over month or the trend in M2. There's still lots of liquidity by a lot of estimates, including from I think Jamie Dimon of JP Morgan is of the opinion that there's probably a couple of $1 trillion in liquidity or savings, excess savings that the consumer has. Just doesn't really feel like there's a shortage of liquidity in the system. So with that, let me wish you a good week. Let's see what happens on Wednesday. All eyes will be on the CPI, where everybody's looking for a good number. Let's see if the extent to which the market already discounted that and what it does on that number. We'll be putting out quick takes on it and the usual daily morning briefings. Thank you very much.